The second commercial Biani webinar. The first one was on shareholders agreements, and this one is on sale and purchase journey. Oh, how can I got to my slides aren't moving great. Which button did you press?
Just
right. All the technicalities. A little bit of admin to start with, which if you have a question, there's a Q&A box, but if that's not working, please just put it in the chat box, and my colleague Grace will see them, but we'll probably address those at the end. But if there's anything really burning, then try and make us aware of it so that we can answer it. Other than that, I'm always there on the end of the phone to talk about any points that you've got. Happy to discuss anything, and hopefully after the end of this you'll have a good idea of the questions that you might have, because you might not know what you don't know at the moment. Mm-hmm. So I wanted to start this with including Jay. Jay is our managing director and has recently been through the sale of the business to Make UK, part of a strategic step by Jay. And I wanted to give you a grounding into the decisions that led her to do that and how she found the process, because it's always good to have a real person telling you about things. So we've got a few questions, but obviously Jay may ad lib as well. It'll just be for a few moments, but I thought it would be an interesting start. So Jay, welcome to the webinar. People sell their businesses for a variety of reasons or buy businesses, for growth, for all sorts. But for selling, what was your motivation?
So I think the main motivation was to take care of succession planning. I started the business 10 years ago, and for the last couple of years I was getting slightly preoccupied with what I would do with a successful business, more successful than I perhaps anticipated when I started it. But I wanted to make sure that there was a future for the firm. And I did explore an EOT and an MBO, but we weren't really made up in a way where that sort of would have worked. And so a sale was really the ideal option. But yeah, it was to start thinking of the future rather. And I'd heard about lots of law firms, that kind of people get to a retirement age and don't do these things early enough, and then are left really just needing to find a home. And I wanted to have as many options.
Almost like yeah. I mean, it's hard to do it on your own, and it's something you've never done before, which is a phrase that I don't want to repeat too many times in the course of this. But you don't buy or sell a business too many times in your lifetime, and for you it was the first time. So how did you know how to start?
So I was being approached, and I tried to cobble together what I thought might be, the right sort of conversations to have initially. But then I decided that actually I really do need some help. And so I've got some a business advisor, a broker on side, wanted to hear what they could do for me. And actually I couldn't have done it without really good advice, because there's so much more involved than I anticipated, even with, a small business.
I think that the broker was able to provide quite a lot of help with valuation and how to market the business. Yeah, give you a channel for that.
Yeah.
So some steps are really hard of the transaction, which I'll be going through, and one of them is the due diligence step. That's really time heavy for a seller, and particularly with you being the only shareholder at the time. How did you manage that and run a business?
Yeah, that was really challenging. I think the biggest problem was that, I couldn't share the information with my team who I'm, really close to,
Mm.
and uh, it was really hard because I wasn't close enough in many ways to my own business to know about all the contracts that we had in place and all the due diligence things that would be needed. So I did then take one person into my confidence, who I completely trusted, and that made life a little bit easier. But there was so much more,
Mm.
so much more involved than I thought. And again, my advisors helped me a lot with the due diligence and guiding me on what sort of things I needed. To start thinking about at an early stage.
Yeah, preparation.
Yeah,
Mm.
absolutely, yeah. And in fact, the whole process took quite a while because, I didn't feel I was ready when I first started having conversations with them.
Mm.
So it probably took about 2 years really from,
Yeah.
starting the conversation.
So that was legal aspects and financial
Yeah,
aspects.
yeah.
And then when you got going, what bits surprised you as to how time consuming, apart from due diligence, and complex they were? Um,
Um, I think the things that surprised me were that these things do take time and you're kind of reliant on other people. So although we actually had information put out about the firm, which I was really nervous about actually. But but then you have to wait for responses, and then some potential buyers were really interested, but they were taking time coming back and
mm,
everything, and there was more interest than I thought. So the whole time
which is a
thing
good
really
place to be in.
it was great. It was great, but it is a real roller coaster as well as
Yeah.
doing your day job. And you get excited about a particular prospect, and then that actually doesn't turn out to be how you'd imagined it would be, and so things were moving all the time. Yeah, so that was difficult, and the complexity. So things like warranties and what is it? The
Indemnities
indemnities, yeah,
and the disclosure
and the
letter.
disclosure letter. So all these things I didn't really know about. Again, I needed a lot of guidance on that, but that all took quite a long time
Mm.
to get everything nailed. And then because the buyer, in my case, I chose to go with an organisation that had to sort of tick a lot of boxes. It's a membership
Mm.
organisation. So there weren't just a couple of people making a decision, it was reliant on a board agreeing.
Mm.
So that sort of took some time.
The one we've not got on here, but you've stayed on. You negotiated for that. That's working for you.
Yeah.
It's often an issue for other sellers. What kind of words of wisdom would you might have for helping that to happen? Right, you've owned a business, you've been your own boss. How's the difference?
Yeah, I mean it is different, of course. I'm really enjoying it because one of my motivations was to give myself something that was more national and more strategic. I've been an employment lawyer for 34 years, and I was really ready to do something different. So although I'm still doing the day job
Mm.
at Bayani Law and heading it. I've got a fantastic team, so I don't have to do nuts and bolts anymore. And I was starting to get to a stage where I thought, well, what am I going to do
Mm.
for the next few years of my career? So it's given me really re-energized me. But I think the key is choosing the right buyer, because I was fortunate to have, I think, 6 potential, viable buyers, and some I could have made a lot more money on if that was my prime
Mm.
motivation. But I needed to make sure that my 3 key objectives were met. One was that my team were protected and kept on and given more opportunity rather than anything taken away from them, which was always really at the top of my list. Secondly, that my clients, some of whom I still work with 20 years on,
Mm.
that there wasn't going to be any upending of what we've created, and we had room for growth. And thirdly, of course, that I found something that was more, that was fulfilling, and that I wanted to be a part of, which I think I
Mm.
chose right there.
Great. And if you had to do it again, what would you do differently?
Um, I probably I'd probably get advisors on board sooner,
Okay.
because um, I learned a lot during that process, and Had I done that, I might have shaped things a little bit differently. But you know, I'm quite good at finding information. So I've talked to lots of people that have been
You
through it.
found you some good books, you
Yeah, I
said.
found some books that I'd really recommend. So I read something called Built to Sell, which was really good and actually fitted our retainer model that we've got. And you know, I learned a lot from that. And then another one was called Finish Big, and somebody recommended that to me, and it was really interesting because it makes you focus on what kind of seller you are. So some people are very motivated by, you know, the bottom line and money. Some people are very motivated by what control they'll still have going forward. And for me, you know, legacy and all of that was important, and my team was really important, more than just the bottom line. So yeah, they were really good books to read, I think.
Yeah. Thanks, Jay.
Yeah. Thank you.
I thought that was really useful. Thank you.
Thanks. Right, I'll leave you to it.
Okay. Okay. So going to get down to some more nuts and bolts here now. I have to start with, you know, setting out the main types of business transactions for selling. And when I say sell, I also mean purchase. If I put it every time, it would all get a bit clunky. There's a few slides here about asset sale and share sale. I could do a whole seminar on these, but I wanted to include them for completion, for completeness. And in the main, we will be assuming that it's a share transaction, and where relevant, I can kick in and then say where it's different for an asset. But the main point that I wish to bring up here is find out what you're selling, what you're buying first. Is it an asset sale? Is it a share sale? What do they both mean, and what does it mean for you for tax, and how the money is going to be distributed at the end? Who's selling? Who's buying? What are you buying? And by that I mean, with an asset sale, it might not be all the business. It could be the name. It could be certain contracts. Probably not any liabilities, but there may be some that you wish to pick up. And the transaction is between the selling company or partnership or sole trader and the buyer. I put company here, but it could be any buyer. With a share sale, it's the shares that are being sold, which could be the shares in a topco with all its subsidiaries, or it could be the shares of just one company or a subsidiary. And it's not a cherry pick exercise. It's what we lawyers always refer to as warts and all the business. And so that's why there is a greater emphasis on due diligence for the whole company, because you are finding out everything about this company and not being able to fence off certain liabilities that the buyer is not acquiring. Different models suit different businesses, and the outcome is very much drives what people want. So a seller of a company probably doesn't want to just sell the business because they don't want to have to sort out the company without assets at the end and wind that up, etc. But there might be, and sometimes that is more tax efficient, out of the scope of what I know, for those things for advice. But it is driven by what the parties agree, and who's got the stronger assertions at this point in time. Some businesses have to be share sale, such as those where the main accreditation, main contracts are not transferable. It would be very tricky to do an asset sale where the contracts have got to change hands and be assigned, if that would cause problems with the actual contract, and the main contract could be terminated as a result of those actions. That can often be the case of why apprenticeship businesses are sold as share sales, because the entity is staying the same. The ESFA and Ofsted, etc., is not change. Doesn't have to get concerned with there being a change. They're just concerned with there being a change of control. Who are the shareholders that they want to do their checks about, and that is why those kind of businesses are always share sales. I've got some slides here about the advantages and disadvantages. As I say, I've put these in for completeness, but I am going to flick through them. And if you wish to have the slides after, you can pick these up and have a later read. But it is a matter of its own webinar, really. So, good summary as to what I've just been saying about the differences. I do get it sometimes where people are not quite sure what they're selling, and but it becomes clear after they've spoken to their accountants and me as to how the sale is going to be structured. And it may be that you have to do some restructuring before you even get to the point of sale. Do you need to put a certain business in its own subsidiary to be able to sell that off? And that has tax consequences and planning that need to be done at an early stage. So I wanted to start off with how one of the points that Jay mentioned about starting early. With a share sale, there is going to be a requirement to get all your documents together for the due diligence process. This is really useful to find out what you don't have. Oh, I need a contract for this. My employment contracts are out of date. I'll reissue those. So you're not doing it all, if you're a seller, all as a rush just because the buyer's asked for them, because that's a bit reactionary rather than planning. I would say go so far as putting key documents in folders. If you start numbering them, you are making more work for yourself, thinking, oh, I'll do a nice index and things like that. But the problem there is that the questionnaire that you'll get from the legal team or the finance team of the buyer may well have different numbers and things like that that you need to then sort out. It's an admin job, I appreciate, but it can ruffle feathers. Oh, I've got it already. I'll just put that in as that. Well, it needs to correspond with the numbers of the question that you've been asked in the requisitions. We'll talk about that more in a moment, but make sure you've got all your sale contracts, all your employment contracts together, you know where all the property documentation is, and that you have the structure right for your business sale. Is it all of the shares? Do you want to take property out first? Is that going to incur quite a lot of a tax charge? Those considerations so that you're ready for sale, and then present yourself to a broker, choosing carefully for the right business industry, and they are invaluable with your accountant to give valuation support and marketing support. You may find that someone knocks on your door and says they want to buy you and you don't need a broker. Great. But I would say be prepared for engaging with a good organisation for that. It can be a business sales agent, can be corporate finance firms who send out information memorandums and help with the whole financing of the transaction, and they want to be involved in the legal, the finance, and the due diligence for a fee. That can be good. Make sure that you know what you're getting and how much it's going to cost, and also, you know, whether you're bound in by any exclusivity provisions that you can't sell your business with through another party. A bit like selling a house when you sign sole agencies, that you know the basis of that you've contracted with these brokers, corporate finance firms, and what they're going to charge you. Is it, well, we'll do this and you pay us X amount, and then we'll do this and you pay us again. So fixed fees for stages, irrespective of whether it leads to a sale, or is it a no sale, no fee, or is it a combination of them both? But those percentages of the consideration can add up, but you wouldn't be able to have got your company to market without using a broker or a corporate finance firm. So in many circumstances, so it is what it is, and it's a bit like, as I say, using an estate agent for selling a house. and they help you go through the offers that come in and make sure that you appreciate how much you might actually get in your hand at that time as a result of the offer. Does that person need finance? Is that better offer? Those kind of discussions, and also act to keep other professionals that you engage along the way, your own law firm, your accountant, keep them up to date and project manage it. So getting those people in place is key. And then once you've got it on the market, and hopefully some expressions of interest are coming about, there's negotiation. What in the share sale, it's mainly about the price. What is the actual price that you will get? Is it cash free, debt free basis with a working capital? What's added in? What's taken away? And to get to a place where you're confident that you know that the price for the shares has an adjustment, but what that adjustment will mean in real terms. I often see letters of intent, heads of terms, that just have a let's say 500,000 for the 100% entire issued share capital of ABC Limited, but no mention of the cash in the business, which you've built up as a seller, and it's your retained profit, but you haven't yet taken it out. So has that been forgotten, or is it intended that that would stay with the buyer, or do you want to have the number that you've negotiated for the share price plus the adjustment to get the cash out, less the liabilities, with and talk about whether that also includes a level of working capital. So getting the headline terms in the heads of terms is really important. In an asset purchase, the heads of terms will really set out what you're buying and what you're not buying. And that helps both of those documents for both types of transactions, help the lawyers to draft. And I will go into more detail, but that's enough for now. And we've got the due diligence stage, we have a documentation stage, and then we have closing. And after that, integration, taking over, dealing with your money as if you're a seller. So heads of terms, letter of intents, they're non-binding, except for certain provisions such as confidentiality, exclusivity, and whether some restrictive covenants about not taking on employees have been put in. And there's two ways to approach this. Is it really just the headline terms that are going to be put in so that you know the price, how that's going to be adjusted for a share sale, how it's going to be adjusted for an asset sale based on prepayments and apportionments and things like that, and leave it at that, being silent on quite a few items? Or is this the time, although it's not binding, to put in a lot of detail, such as the caps on liabilities, the restrictive covenant scope, and things that you would normally just deal with once you've got the share purchase agreement, because you feel that I'd like to know that they are on the same page as me, are both parties, and if it's in there, it's hard to go back on. It can work both ways. Sometimes we might miss something out, such as we hadn't, the parties might not got so far as the seller wishing to have security for any deferred consideration, the money that they're not getting straight away. And the other side solicitors might say, well, it wasn't in the heads of terms, so no, we're not dealing with that. I have had it both ways. And I think sometimes there is benefit on spending time making these heads of terms to be quite detailed, so that even though not binding, it is a good pathway to what's going to be in the share purchase agreement and reduce the negotiation steps on what essentially is a 100-page document. And can give people time to seek to get a better deal because of things that are not in the heads of terms. I don't know the answer. It depends on how the parties are reacting to each other and how competitive the lawyers on the other side are being. And it rankles sometimes when you think, well, I didn't put it in because it was only heads of terms, but so just bear that in mind. And I have said involve lawyers and accountants before signing. Simply to make sure that the money does work out and the adjustment mechanism works out for your business, be it completion accounts or a locked box, because your accountants will know which one works best for you, and lawyers can spot what hasn't been included, where there might be some sneaky cost clauses, and also to help you understand the exclusivity provisions, that they're not stopping you from selling the business for a long period of time, even though the potential buyer has walked away, and also whether there are any cost liabilities in those clauses. For a seller, for a buyer, you will want an exclusivity clause because you're going to be putting quite a lot of effort in this process, and you won't want the seller from signing up with somebody else during a particular period of time. But this all needs to be reasonable and upfront in the heads of terms. I do find that in the heads of terms, it's not always clear who's buying, because a buyer wants to keep that open. Potentially they're going to set up a subsidiary for that, or they might get funding better through a different part of their group. That's fine, but it makes it hard for a seller to do buyer due diligence. And in the apprenticeship field, when notifications need to be sent to the ESFA, 12 weeks with 12 weeks notice, it needs to be really clear who the buyer is and who the buyer's board and directors are going to be. Because changes to that could start the 12-week period again. If you're in the apprenticeship world, you will appreciate what I am meaning here, but the ESFA contracts have a strict criteria on change of control and the time steps for doing that, and have forms for notifying them. Penalties could include them being able to terminate the contract if those steps aren't being taken. So everything needs to be known about a buyer early on for buyer due diligence and for any regulatory steps like that. In a share sale, the buyer, again, thinking about the sellers, are they individuals or is it a corporate seller? And the buyer will want to make sure that all sellers sign up to heads of terms for the confidentiality aspects and exclusivity, but also they'll want to make sure that where there are individuals, that it includes all the sellers if they want to buy 100%, and that there are means of compelling those minority shareholders to sign up to the documentation. So we'll be looking at drag clauses and just, or everybody is on board with the transaction. So it's a key document, it really is, and the parties and what you're buying and what you're selling are there up front. Price. You're in an asset sale, it's normally sale of contracts, the benefit of contracts, or a property, or the name, and those have a notional or an actual value attached to them. But in each one, there may be things to think about, such as the ability to assign them, to transfer them to the seller company or whoever it's going to be. And that's where due diligence comes in, to find out those assignability clauses, but also to assess what the tax might be for moving a property from ABC Limited to to the buyer company, because that will be a transaction. It's normally apportioned between the asset types in the asset purchase agreement, but normally for heads of terms purposes, it's an amount that is going for the whole business of the agreed assets. With a share sale, there's lots of language floats around here about enterprise value, equity value. We're buying it for X million pounds with an adjustment for net current assets, for an adjustment for net assets, an adjustment for cash liabilities and working capital. And that's when I think it's really key that that mechanism is determined in the heads of terms and given a tick and an analysis by the sellers and buyers accountants. It can be a shock when people think, oh, I thought I was getting this amount, but then they realise that the bank loans that are quite substantial have to be taken off that figure before they get the amount. I'm going to dip out a bit here and say there is accountancy advice rather than legal advice, but we do guide people just to make sure that they have taken the correct steps before signing it and are happy that they know what the outcome will be. I'll leave that one for later reading, but it can be a shock sometimes to find out that you're not getting quite the amount of money that you thought you were. Payment structure in heads of terms is useful to include because this helps the seller know when they're going to get the money, whether they need to have security, consider security for any money that they're not getting straight away, but also, is it an unconditional amount of money that they're getting on completion? Is it an amount that they're getting on completion or that the buyer is able to pay on completion, with some being left for later on a conditional basis or a non-conditional basis? And they are going to be really key considerations for the interest that a seller has as to the offer that's being given, because it may be that someone else is happy to pay all the money straight away for the shares. Just to be clear here, the shares are being transferred on day one and not as the money comes in, but the seller has to wait where there's deferred consideration for the time the earn-out provision to have clicked in. And it always becomes a topic at that, well, how do I know I'm going to get my money? And that's when talk of charges on property, maybe property owned by the company could have a charge on in favour of the seller, personal guarantees of buyers, parent company guarantees, that security, a nod to that at least, that there will be security in the heads of terms, even if you don't know what it is at that point in time, can help the buyer from stop turning around and saying, well, it wasn't in the heads of terms, I didn't expect to give it. So I want to bring that out. It could be that the heads of terms just say warranty limitations and warranties will be customary for the transaction. Same with restrictive covenants. That can be fine, or it may be that these are really something that the seller wishes to nail down and put in. So it can go either way on that. And if it's really important that the seller or one of the sellers knows what their package is going to be if they're staying on as an employee or a consultant, that needs to be either as a little side letter just for that person, but kind of determined at the right time so that that particular seller is keen to stay on board. Exclusivity is going to be a binding clause because it's a promise that the seller won't market, talk about, or will stop any current negotiations that they've got on with other parties other than this particular buyer. And it's a lock-in period that can be extended as you go along with the transaction if things are being delayed. There's always going to be some penalty for the seller in breaching that. But you have to be careful that is just, what that might be. I think costs can be capped, but equally, you it needs to be careful that you know what you're signing up for in that exclusivity arrangement and not writing an open checkbook. But you are in control of your activities as a seller. But if it's a bigger group, you need to make sure that everybody is on board with that and doesn't cause there to be a breach. I also like to find out that the buyer's funding is in place early on, and particularly at this stage, because again, it helps you decide whether that's a good buyer or whether they still have quite a few hurdles to do before they can get their funding. And there's not much you can do as a seller to manage the costs that you've spent up to the date of if the sale doesn't happen. There's only once in my career that I've managed to have a clause in heads of terms where the buyer had to pay the seller's cost if they didn't complete. It turned out it was used, but it's very hard to negotiate. And sometimes people do walk away because of the due diligence, because they can't get funding as a buyer. And unfortunately, the seller will have been exposed to legal and financial advisor costs up to that date that they won't be able to get back. So getting to this stage has some cost consequences, and obviously we all hope that it's going to happen, but it might not. So in the slide where we had the stages, we're now on the due diligence stage, and I've indicated that you can start this yourself as a seller early on. Preparing for sale, we can help you with that, with giving you a typical questionnaire, and you can put things in folders, analyze your contracts. But this is when the buyer's legal and financial teams start getting down to the nitty-gritty of looking at the documents. They do this by sending requisition questionnaires to the seller's team. So to the seller's team, and then which could be legal and financial. And then with the help of those advisors, the seller populates a data room. It can be very detailed. There is generally one for legal, one for finance. They may overlap, such as the legal one might ask for questions on articles of association and things like that, and so might the finance one. There may be two different data rooms. There may be tabs for legal and finance, and we need to find a way of cross-referencing. The requisitions will ask questions that need an answer and then reference to the document, and that document will be put in the data room. So sellers need to consider how much help they want with this process, and different industries are used to filling out questionnaires and having documents at their fingertips than others. But it can be quite time consuming and potentially not cost effective for the seller's solicitor to get too involved in the input of the due diligence material when a seller could manage it if they can. But that doesn't mean to say that, that help is not possible. It's just something that sometimes the seller will think, well, I can do that, so I don't want to incur an hourly rate or chip away at my fixed fee for that amount for that work. And I would say that if you're being given a fixed fee, then there would be a separate one for due diligence, as opposed to the whole transaction. It can be quite a drain on sellers. They want to keep secrecy, but as Jay alluded to, does the seller actually know where everything is? Is it held by ops teams, and you have to ask surreptitious questions as to having, can I see that contract? Can I do this and that? And the bigger the company, teams might have to be aware of what's going on, and ask for help. Sometimes people say, oh, having a general audit and I need the information. or dress it up in some kind of request with their internal people. But in the end, I'm sure that people do guess, but if they haven't been told specifically, it's tricky for them to broach it with the seller. But it can be tricky, and it can drain a seller. But you can't sell your business without giving the information. Is all I can say. The data room is usually something online. It's usually a packaged data room rather than just using Dropbox, although that is possible. Some law firms don't allow Dropbox because their security systems don't allow it. Using a data room package does allow for the folders to be numbered, and anything that drops in gets a number, and also for the indexing to be a lot easier. So we do favour those from both teams, and the data room is set up so that the seller fills it all out, populates it, and then it's released to the relevant people in the buyer team who sign in and are given permission to look at the material. And they ask more questions, and then more documents need to be put into the data room and questions answered. Being speedy, being helpful, being open and transparent in this process can give a buyer team a lot more confidence in the answers that they're getting from the seller team. If there's delays, the buy team might have trouble saying, oh, well, our accountant's not available now, but they were available if you'd got it in quicker. And all these things can cause a bit of friction and delay. So it's quite useful for timetable for due diligence to be arranged and agreed early on, so that people make sure that everybody's available, and that it's dealt with as a matter of priority when new requisitions come in. And then it's continuing. So although they might not be further requisitions, if you're, as a seller, if you've renewed your insurance in the meantime, then those new insurance documentation needs to be put in the data room and flagged to the buy team that you've put something new in the data room. And some data rooms, the proper packages, send a note to a buy team or the people signing in daily or weekly. So this has been added in, and that can be really, really helpful, because as a buyer, if you've been told, oh, something's been added, but you're not told where, when the data room is getting really populated, that can just be terrible to have to find out where it is. So we do best to make life easy for the people who are doing the due diligence. And what are they looking for? Well, the contracts, they're looking for the change of control provisions, whether they need to get consent from the contracting party for it to, and it won't terminate because it might be a real key contract. They're looking for how long the contract's for, what its obligations are, what the termination provisions are, and whether it's going to cost them a lot of money to fulfill those obligations. Property is a bit like buying a property. There'll be normal CPSEs, searches, reports on value and the status of the company, leases, looking at dilapidations, many different aspects to the business, and that's why it's very useful to have a look at the types of questions you might be asked at the beginning, early on, so that you're going, why do they need to know this? It'll help you appreciate why they do. And for the buyer, it helps them understand what they're buying, what they need to sort out or ask the seller to sort out beforehand, what they might need to put in as indemnities in the share purchase agreement, and whether actually what they're buying is worth what they'd thought in the heads of terms, because the price in the heads of terms isn't a binding provision, and it can obviously be sorted and negotiated as part of the due diligence process. I think I've spoken about most of these things here in the other slide. So I've got a recap of it being ongoing. One thing I'd like to say is the data room and the discipline of using a data room and replying to requisitions can erode with time. And you may find that I do find that people take discussions and due diligence inquiries outside of the data room, like a tax advisor might ask their own questions, but in an email, and then that'll get responded to. I would like all my sellers and buyers to make sure that that documentation is still due diligence and needs to somehow get into the data room. And the reason for that is if, as part of the disclosure letter, the sellers are allowed to use the contents of the data room as a general disclosure, or you need some of those documents that have come out as a result of the offline, out of the data room discussions to be part of the disclosure letter bundle. We'll talk about that separately later as part of the process. If it's not in the data room, it's hard for the person doing the disclosure letter to find them again. So discipline is key, and that can be a little bit tricky as questions go offline. So here's an indication of the kind of questions that you would be asked, all about ownership and the governing documentation. I found recently that having all the company books written up to date is coming up key, and it's sometimes necessary to reconstitute those company registers at this stage, making sure that the articles are up to date, which there will be at Companies House, and can be gathered together. I'll also ask you if there's a shareholders agreement, and again, finding that, making sure it was signed, and putting a copy in the data room. Key customer and supplier contracts. What's key? Well, you may wish to go with well, I'm even going to put the photocopying contract in. I'm going to put the water filter contract in. Fine. Those kind of contracts do have some provisions that you might need to disclose later on. The printer contract might be for a fixed term of 3 years. You've just renewed it. Or it might have a termination clause that you've just missed and therefore it's rolled into another 3 years. Those kind of things might come out as part of the due diligence and would then need to be disclosed. So, yeah, fine. So long as you're not multi-million company, it's probably manageable to put most things in. Employment and pension records are key to go in. Intellectual property rights. Here I'm including your rights to use certain software that the business uses, but also if you've invented things or have certain bespoke software or use certain trademarks and things like that, to make sure that they are in the data room and show the correct ownership. Websites are sometimes where we find that the ownership of those is a little bit harder to find out. Property leases and deeds, the buyer will be looking at how long the lease has got left on it, what the dilapidation clauses are, all the things that you'd normally do when you're as if you were buying the property, but they're not actually buying it because it's not changing hands. If it was an asset sale, then the lease and the property would be being assigned, and it's almost like a property sale in its own right. Litigation details. Are you being sued by anyone? Are you suing anybody? Are there any, going back to employment, are there any employment disciplinary things going on at the moment? And all the insurances. This is the legal due diligence. The financial due diligence will be up to what the buyer's accountant and tax advisors want to ask. Usually all the proper accounts, the full accounts for the last few years, the corporation tax returns, VAT, R&D claims that might have been submitted. I'll leave that with the finance teams, but as you can see, there's another aspect to due diligence that isn't just legal. So, drafting of documents. Shares are sold by a share purchase agreement, which you may have heard of SPA. For a seller's point of view, they just want to sign a stock transfer form, but a buyer will want to make sure that there are warranties, indemnities, tax covenant, restrictive covenants. So a stock transfer form doesn't shake it for that. A seller will want a share purchase agreement if there's deferred consideration, because they'll want the promise to pay to be recorded. A share purchase agreement is drafted by the buyer's team. And the buyer's team may not wish to start on that process until the due diligence has been completed, which again can cause delay, but you can see why, because that's when legal time starts getting spent. And if you're not happy with the due diligence, then you may wish to keep a curb on that. It may be, just going back to due diligence, that companies do the financial due diligence first and then the legal. And that can cause delay again, but it can make it a little bit more manageable for the sellers, and also allow a buyer to decide, well, the numbers don't add up, or the numbers add up, I'll now progress to legal. So there are many different combinations of the order of things. With an asset purchase agreement, it depends where you are in the country, really, as to who drafts this. But the consensus is usually that it is the seller. But I've done it both ways, so it's not quite so cut and dried. I think it works both ways for an asset purchase agreement, as to who it's not really so precious as to who drafts it, because the seller will want to make sure that they know what they're selling, but the buyer will want to know what they want to buy. So it's not so hard and dried, cut and dried there. So I'm going to concentrate on these provisions in a share purchase agreement, because they're the ones that always need more explanation. Some of these don't apply to an asset purchase at all, like a tax covenant, that's not there. But the others have relevance. In an asset sale, there will be, and it would be in the first slides that I skipped through, the additional aspect of TUPE, transfer of undertakings, the movement of employees from the selling company or business to the buyer. Bioani law provide that advice all the time for sellers and buyers as part of the employment provision and HR provision. But that will a key aspect of the due diligence, and another process that needs to be done as part of an asset purchase that isn't involved in a share purchase. Having said that, in the information that you need to give for employees as part of due diligence will be very like filling out a transfer of undertakings information sheet for employees in the share deal, whether it's anonymized or not. You know, what's the holidays, what's the benefits, how long they've been there, those kind of things. So we're doing okay for time. Got quite a lot of detail, so I hope you're still all with me. Conditions precedent. This isn't used an awful lot, but the language of exchange and completion, split exchange, simultaneous exchange and completion are often battered around. And I wanted to explain what they meant. Normally, exchange and completion happen on the same day, that the contract's exchanged and the money is paid, complete, congratulations. But if there's a period of time that needs to be between the contracts being signed, the share purchase agreement or the asset purchase agreement, and it's then conditional upon X, Y, and Z being in place, the conditions precedent, before completion, then you need the document to have split exchange clauses in. They're the interim period, and you want to keep that interim period as short as possible if you're a seller, because you don't want there to be any. It's a very stressful period because you don't know if completion is actually going to happen. I mean, what if there's a breach of warranty in that period that causes the seller to walk away? I don't know, say one of the property burns down and they don't want to buy it anymore, or a claim comes in, and that causes them to wish to start to negotiate the price again, or say, well, it's absolutely fundamental to the business and we don't want to it's a breach of warranty and therefore we can walk away. There's also some cost aspects that come into play, in that if there is potentially a breach of warranty in that period of time, then it may be that these interim clauses say that the sellers have to pay all the buyer's costs up, and that could be for the whole transaction. So I never go into interim periods and split exchange lightly. There's not many reasons why it's needed, and I've put a few down there. But in the end, I always think, well, just don't sign until you've got those consents ready, unless for some reason the person giving the consent needs to see that there's been a signed contract. Often they don't. So I just think it adds a lot of complexity in the negotiation and risk for the seller. And it may be there's a lot of extra cost as well, because there will be a disclosure letter on exchange day, but you may need to, as a seller, need to do a new disclosure letter on completion, and there's more board minutes. That's not anything to sway it, but the disclosure letter requirement, you may be allowed to make a further disclosure letter. So sometimes these can be about, a couple of pages for the interim period that look innocuous but can have some tricks about them. So let's go with simultaneous exchange and completion where we can. There. But completion is when there is the legal transfer of the shares or the legal transfer of the assets. So a share purchase agreement and an asset purchase agreement will set out clearly how the money is to be paid, usually to between solicitors. So from the client, the buyer will pay their solicitor's client account, and that will then be transferred to the seller's client account, and then the seller's solicitor will distribute it as the transaction requires to the different sellers, or also pay out any third party costs that the sellers have agreed that they can. It will document whether there's going to be shares instead of cash and how that's going to happen. So maybe there's shares to be allotted or in the buyer, or even as part of the transaction, or loan notes. Whatever payment method is determined, when and how the payments are going to be made. So is it all on day one? Are there payment dates of unconditional amounts of deferred consideration, and each one then will have its due date and interest accruing if it's late, or if a payment is late, does it mean that all the remaining money is triggered to become due, or is each one a distinct breach of contract? If there's an earnout, what's that based on? Who's going to determine whether the company, the target, has met those figures? Is there an expert way of determining that if there's a dispute? And what's it based on? And then the adjustments that I talked about on getting the cash out of the business, cash less liabilities with a working capital adjustment or net current asset adjustment, again, potentially with working capital adjustment, or a net asset adjustment, all will need to be set out, and whether completion accounts are needed to determine that, or whether everyone's decided that locked box with the parties were being able to know what they're getting on day one, and all these terms of leakage and permitted leakage documented. That's, again, a little bit too much detail for me to go into what each one is in this set of slides. But if those kind of words are being used as part of your negotiation, then pick up the phone so that we can make sure that you understand what they mean, or can put you in touch with people who can explain what it means monetarily to you. So lots to document for price and payment. So Jay mentioned that she wasn't aware of how important warranties were. She knew what they were, but she wasn't aware of how, as a seller, they impacted her in the share purchase agreement. And this is something that wouldn't be given the benefit of the buyer if they just accepted a stock transfer form. And the warranty section has two parts. It has caps and liabilities, and then it has a section, usually in a schedule, of what all the warranties are, which can be very, very detailed. And I have to say, it's quite interesting how sellers react to warranties. They go, well, they know all that. I've just told them that in the due diligence. Why are they asking me again? But the due diligence is not a contractual obligation. It's just it's a poke around, find out, ask questions situation. This warranty section is the means of saying in a contract, I'm assuming that there is no litigation. And you go, and the seller will go say, but there is. I've told them that that June that someone slipped in the factory and there's something going on. Warranties are in the share purchase agreement and they stand there. We don't edit them in the share purchase agreement. We use the disclosure letter for the sellers to counter any of those provisions. Talk about that a little bit more, but the warranties can be very long, and sometimes they can act as a almost in addition to all the requisitions that you've been asked on a legal and financial basis, because there may be bits that you weren't even asked about that now need to be considered as a warranty aspect, but were not included in the due diligence. Buyers don't use warranties as a substitute for due diligence, though, because they're not quite sure what might come out as a disclosure. So there shouldn't be too many surprises for a buyer as to what's going to go in the disclosure letter based on the warranties. If this were an American kind of contract, then the warranties are edited to include there is no litigation except for, but we don't do it like that. We have, and this, so I suppose one reason for this talk is to say how things are done and why. And yeah, we have certain views on that from sellers as to why, but it's not going to be reinvented just for that one way of doing it, because it's a process that is ingrained in how things are done. Maybe changed or come, but we're not there yet. So those warranties are agreed as at completion. So the given, when I sold the shares to you, I can say categorically that this wasn't happening. So when a buyer takes the business and finds out within a certain period of time, the warranty period, that one of those warranties may not have been true, they have an opportunity to claim damages and money back from the sellers as a result of that warranty not being true. But there will be limitations to that. This is the financial cap on the liability, and also the trivial claims being excluded. So often this is worded that normal claims, contract claims, have a 18 months, 2-year period for the buyer to make a claim. The buyer can't make a claim for warranty claims that are less than £2,000. And of those £2,000 which become actionable, there have to be, say, £10,000 worth of the actionable claims before a claim can be made. These things are the ones that lawyers edit and negotiate, and as I said in the heads of terms bit, can sometimes be done away with if you've already decided what those caps might be in the heads of terms and save a bit of time now. But there are guidance as to what the trivial cap is normally and what the basket is normally as a percentage of the purchase price. Normally, sellers are not liable for more than the purchase price, but where there are multiple sellers, their liability is usually joint and several, which means that the buyer can make a claim for a breach of warranty against just one, if they think that one person has more money and is able to meet the claim than the other. That can cause a bit of an upset between sellers, and then the seller's solicitor will have discussed with them the possibility of doing a deed of contribution between sellers, which is not seen by the buyer, but helps to moderate that situation so that if one shareholder has a claim against them, that the others will compensate them to the extent if they've not, and probably usually pro rata to their shareholding. Timescales are something that gets battered around. Shorter the better for a seller. And as I said there, the disclosure letter allows sellers to say, yeah, that warranty is true, but I'm telling you that this and that and that are contrary to that warranty, and once those disclosures have been made, then the buyer cannot make a claim for a breach of warranty to the extent that they have been disclosed. So the disclosure letter is a key seller protection document and can take some time to sort out, because if you think that you've got paid a whole schedule, maybe 10 pages of warranties, and each one needs to be considered carefully as to whether there's a disclosure with a reference to a document for a full disclosure, hopefully using the data room for that reference, that can take some time to cross-reference everything and to make sure that everything is covered, and not giving a blanket, yes, it's in the data room, will not normally suffice for the specific disclosures. So if there is a claim, then buyers have to prove that it was untrue, that there was loss, and it can be quite hard to bring a claim, but they'll be keen to send a letter before action within the timescales, and also to comply with any serving of claims within time periods, filing of claims and service of claims within time periods, to make sure that they keep those warranty claims alive. It's not nice for sellers to think that there's this millstone around their neck of if there's a breach of warranty. Sometimes things can come out of the blue that a seller didn't know about. But through the whole due diligence process and being transparent and using disclosures, there shouldn't be a warranty claim. I'm not saying it doesn't happen, but it's quite rare. But when it does, it's quite distressing for a seller, and it's one of the time spent, drafting, reviewing the share purchase agreement, but also doing the disclosures is very, very key. So indemnities are different. So a share purchase agreement will include warranties, which we've talked about, and also indemnities in a separate clause. So whereas you were able to sometimes to generally have a cap on the liability for your warranties and maybe have the trivial and the basket going on, it's a harder negotiation to get that for indemnities. And indemnities will be where a buyer's found something that they really just didn't want to even bother with a warranty claim for. as part of the due diligence. I've had it where some planning permission wasn't correctly done for a property, and so the buyer wanted to make sure that the sellers would reimburse them the costs of getting that rectified, and if there was a claim for any breach of planning permission before they did, that the sellers would be responsible. I've got here that R&D tax claims are a hot topic, so irrespective of the fact that they could be covered by the tax covenant, another chunky bit of the share purchase agreement, because there's been quite a hoo-ha about R&D tax claims with HMRC now, that if a company has submitted those in the past, then it's likely that their tax experts, the buyer's tax advisors, will say, I'd like an indemnity in case HMRC wants to look into any prior tax claims, that's going to be covered irrespective of the tax covenant. So it shifts the financial risk to the seller, and as I say, it's depending on who you're acting for. It's nice to think you could limit it to the purchase price or the amount that they've received. It's nice to think that you could limit it in some way and tie it into the trivial and the basket. And it would be nice to think that you could also say, well, you can only make an indemnity claim within a certain period of time. But those things are all up for grabs in the negotiation and could vary depending on the deal. Okay, so an indemnity allows the buyer to just ask for, they don't have to mitigate the loss, they don't have to prove the loss in value, but that, you wouldn't just pay up. And it's for high risk issues. For both warranties and indemnities, where there is money still to be paid in deferred consideration, there will be a set-off clause, because if there is something ongoing, yet the buyer has to pay another £100,000 to the seller, but there's been a few warranty claims and maybe an indemnity claim is fluttering there, they won't really want to make that payment of £100,000 and then have to recover it back. So there can be different degrees of complexity of set-off clauses to well, it can only be where it's known an actual loss, or an expert has to determine what the estimated value is. And there are known ways, there are very specific ways of tailoring those set-off clauses to make sure that both parties are comfortable with how the money will be deducted. But really, you can see why a buyer wouldn't want to be making that payment if there was these hanging around. Oh, tax covenant, another chunky bit of the share purchase agreement that both sides accountants will get involved in reviewing, but it covers the fact that there may have been tax liabilities pre-completion that aren't shown in the accounts that cause the buyer to face a tax liability once they're in control of the shares. It can't be as a result of the fact that it's now part of a buyer group and things like that. It has to be something that wasn't known and disclosed at the time. These don't come up too often, apart from whether it's debatable as to whether it covers R&D tax claims, because tax is normally pretty routine and correctly done. If there are tax saving schemes that cause a problem and are investigated, or things have not been properly documented, that's when there may be a risk here. But the tax covenant is a standard part of a share purchase agreement. Restrictive covenants. These are in asset purchase agreements, very detailed as well, because you don't want the sellers from selling their shares, selling the assets, getting the value for it, and then taking customers from the company from the business that they've just sold, using the same name, or a similar name competing in the same space. But you do have to be reasonable in what these are. And sometimes sellers, if they're retiring, put anything in, it doesn't matter, I'm never going to do this again. But where sellers are trading companies, or they still wish to operate in the same space but not compete, then these will need closer negotiation to make sure that everyone's comfortable with what's going to happen in the future. And then there are completion arrangements. You think you're nearly there when you've got all the documentation signed up, but then there are some ancillary documentation about board minutes, resignations and appointments, signing up, sorting out the money, sorting out any security, getting the document list all ready, and that can take a bit of time, but when you start doing this, you are nearing the end. And there are documents to be done. Hopefully the parties' lawyers will share responsibility for these, to share the load. We all know when we start getting ready for a transaction, the money comes in, we've got the documents, and then once everything's signed up, right party is holding the money and everyone's happy, then there can be completion, which involves, which involves making filings at Companies House to represent the new directors, dealing with the share certificates, dealing with stamp duty, dealing with assignments and notifications and consents that are needed. But there will be a plan for that, so that there shouldn't be any surprises. So I have some slides about the disclosure letter. I've talked quite a bit about how that works. And I hope that helps. This is a useful one just to illustrate the different stages. So due diligence identifies the risks. Warranties and indemnities make some of those due diligence answers contractual. And then the disclosure letter helps protect the sellers from the full extent of a warranty claim. In some transactions, the parties don't wish to go through too much detail like that, and they think, well, let's have some insurance for a breach of warranty, and that's possible, but you need to start thinking about that early and consider who's going to pay the premium and who and things like that. There may also be the fact that if you're having funding, that it's not just the buyers as a team that want to know about warranties and indemnities, but also the funders might have their own due diligence to do, which may involve another set of solicitors, which may involve more time and more cost. The buyer has to pay stamp duty using the stock transfer, submitting the stock transfer form, maybe the share purchase agreement, and also making the payment. If there's going to be completion accounts, then you might not know exactly what that amount is. So you can do wait and see, make a payment and then make an adjusted payment later on. Or if there's any earn out, you can that means you've paid too much tax on day, within these 30 days, you can apply for there to be a rebate. But guidance can be given. Company registers and Companies House to be filled out, and then carrying out the integration and merger activities that you had have planned before. So also getting the new directors and signatories on the bank account needs to be thought of pretty early. Although you can do, people say, oh, we can do that online. Banks get in a bit of a flummox when directors are changed and the signatories need to be changed. And sometimes not having access to the bank account for online banking for a couple of days or even weeks can be very difficult for all parties. So it's one thing to not to neglect as a pre-completion things. Have you sorted the bank account? Does the bank know that there's going to be changes? and that they're not going to go in a spin when they see that there's directors changed at company's house, etc. So it can be one thing to manage early on. Okay, and then got some top tips. There can be some transactions that take longer than normal. It's usually a reason. Funding takes forever. Funders require separate due diligence. The whole due diligence takes a long time. And as time goes on, sometimes the need to buy disappears, and so delay can cause exhaustion for certain parties because they are still running their business and dealing with requests from accountants, solicitors to deal with all the documents. So it is a tricky one to deal with. And thinking about where costs are going to come out, it's not just the seller needs to think about, well, I've got some money, but before I get that, there's going to be legal and financial fees to pay, broker commission and any fixed fees that haven't already been paid. And then I've got to think about how that's going to be taxed. And then the buyer has their own fees. They might have a finder's fee if they used someone to help find the target, and they have to pay stamp duty. And in an asset purchase, there may be some stamp duty, land tax if the property is being assigned to them. Okay, so we deal with both sides, seller, buyer, all sorts of businesses, accountancies, training companies, IT companies. In the end, I've dealt with so many. They've all got the different quirks, but the process is largely how I've outlined. Have different timescales for different bits. You can speed through one, and others can take a bit longer. But they are a big thing for people, and I always like to be available straight on the mobile, and being helpful, so that people aren't worrying about having an answer. When documents come in, we try and deal with them as quickly as possible so that we're not the ones causing any delay. But I'm often on the phone with people every day or more than once for 4 months daily whilst this is happening. And having access to your advisors within reason is I think helps make it a little bit easier as far as I can for the clients. Okay, so I finished with 5 minutes to spare. There's been a lot of detail. I don't know if there's any questions. No? Well, that's fine. I would just like to say, if you would like the slides, let us know in the feedback form. I think you have to ask for that at hello@bayani law.co.uk. And the feedback form will be sent, and then if you want a slide, then the slides, let us know. It's probably going to be online as well. If you want to use this in your business, if you're an accountant or a broker, then that's fine. Just let us know that you'll be doing that. If you want to talk to any of your clients, if you want us to talk to you, if you are a business owner, we're very happy to do so, and you will get our full attention when you do. So I hope that that's all been informative, and there are more activities and networking events that we run. So this is something to sign up to, particularly on the HR and employment side. And you will, as a business owner, learn something when these come through, I'm sure. and they're very accessible. So thanks very much, and we'll keep you informed of any future sessions. Thank you.